This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, value investors. Welcome to episode 18 of Value Investing. What I'm going to do in this episode and in the following two episodes is to talk about banks. The reason why I think it's important for me to talk about this topic is because a lot of investors do not know how to analyze banks because their financial statements are completely different from the ones in other industries. So what I thought would be helpful for my listeners is talk about the details of how you can analyze banks so that you can invest your money and find great undervalued opportunities in this area. There are thousands of banks traded publicly out there, so you should be able to find really great investment opportunity. And also, this is going to give you great advantage if you know how to look for good undervalued companies here in this space, because it's going to expand your investment search area to the next level, because many people do not even look for values in this space because they simply do not understand how to find out good banks. So what I'm going to do is in this episode, I'm going to talk about plain vanilla bank business model and try to understand how bank makes money. And in the next episode, I'm going to get into the details in the area of financial statement analysis. So I'll talk about what items you need to look for in order to understand which one is good bank and which one is not, by looking at balance sheet and income statement and identify good banks and screen out bad banks. Finally, in episode 20, what I'm planning to do is to identify bank investment opportunities. So there are different places that where you can look for to find out undervalued banks in the stock market. So I just want to give a disclaimer before I start that this podcast is for entertainment purpose only, and I'm not here to provide any advice to buy or sell certain market securities. It is your responsibility to consult with your investment professional for any investment decisions. Also, I want to mention that a lot of ideas that I'm going to talk about in the 3 episodes are from a book called The Bank Investor's Handbook. I'm going to leave a link in the show note so that you can buy this book if you want. Okay, without further ado, why don't we get started? As I mentioned, this episode is going to be about bank business model. I'm going to explain to you how banks make money. The first question that you need to ask is, how does a bank work? Banks are financial intermediaries that connect people who have money, just like you and me, with the people who need money, usually business owners. What I'm going to do is to explain a plain vanilla bank business model and go through its components. There are 2 important components that I need to touch upon. The first one is deposits from customers, which are the main funding source of a bank. And the second one is the lending practice by different banks. The objective of a bank is to borrow money at a low cost from the people who don't need it, and lend money at a higher cost to the people who need it. Banks can take the difference of the yields as their interest income. Why don't we talk about deposits in more detail? As I mentioned, deposits are mostly coming from customers like you and me. We receive small interest payments from banks in exchange for putting our money in the bank account. However, we don't consider the money handed to the bank as an investment. The reason why we feel comfortable handing over our money to banks is because we know we will get it back at some point in the future. A government agency called the FDIC guarantees up to $250,000 per account to bank customers. So let's say if the bank goes bankrupt, you and I will still get the money back because it's guaranteed by the government agency. As a result, banks can borrow money at a low cost. So this is a good side for the banks. But the downside is that banks are heavily regulated by the government. Now, let's talk about types of deposits and see what they are and which one is good and which one is bad. It's important for us to understand all these things in order to understand bank business model. The first type is something you probably are familiar with. It's personal and business checking accounts. These are the lowest cost deposits for a bank, and banks normally don't pay any interest, which is good for the banks. However, the amount of money in the checking accounts fluctuate more than other deposit types because customers use the money for their daily needs such as paying bills, buying grocery, etc. The second type of deposits is savings account. Savings accounts are more steady in terms of the money level fluctuation, but more expensive for the banks to manage because they have to pay small interest on the money in these accounts, whereas they pay little to no interest on the money in the checking accounts. The third type is called Certificate of Deposit. We normally call it CD. And so what is CD? CD is basically a fixed duration instrument with a set yield. Banks promise high interest rate to their customers and get duration certainty and promise from customers. The last type that I want to talk about here is brokered deposit. So what is this? There are CDs sold by third-party broker networks to customers who do not have any relationship to the bank. So I would say that this is kind of the worst quality deposit among the types that we have just discussed so far because of the following reasons. Number one, this product provides highest interest rates to customers. So the way it works is that customers go to their brokerage accounts and see many CD options on their screen. So what they do is simply pick a product with the highest interest rate without putting too much thought into which bank is providing the product. The problem with this is that there will be no loyalty from the customers who put the money. If later customers find another bank that provides higher yield, they will move their money with a click of mouse. So you can say that this is commodity-like business where customers only care about the price with no loyalty. Okay, we have just talked about 4 deposit types: checking accounts, savings accounts, CDs, and brokered deposits. Now, what I like to do is how you can evaluate a bank's deposit to know which one is a good bank and which one is a bad bank. The first thing you can do is to find banks with low interest deposit structures with little to no high cost broker deposits. As I mentioned, broker deposits are just not good quality deposits, so you don't want to see it to be a high proportion of the overall deposit in the bank as an investor. Usually, the banks with good brand and reputation can achieve this goal of low interest deposit structure, because they have high customer loyalty, and customers' money is sticky in a sense that the money stays in the business at low cost for a long time. This gives the bank a huge durable competitive advantages over competitors. From customers' perspective, 0.5% interest is not really different from 1%. So 0.5% difference is not a big deal. However, from bank's profit perspective, the small difference generates a huge difference in financial metrics such as interest income and return on equity. Because it's highly levered and small things can change in a huge way when you're talking about these different financial metrics. Additionally, I want to mention here that you also need to put things into perspective by comparing the deposit cost structure against competitors with the same characteristics in the same region. In that way, you'll have a better sense of how a bank is doing if you look at their competitors. One last thing that I want to mention here is the interest rate cap that the FDIC imposes on banks. As I mentioned, the FDIC is government regulator. The FDIC doesn't allow banks to pay customers more than the interest rate cap. The reason for this cap is if banks compete with one another too much and provide too much money to customers in the form of interest rate, the banks would be at risk of going bankrupt. So this is a good measure for non-competitive banks. However, if you see banks in your investment watch list whose deposit cost is close to the interest rate cap, it might be an indication that the bank is having hard time to attract deposits from customers. So try to stay away from those banks. Now, why don't we switch gears a little bit here and talk about the other component which is important to analyze a bank. I'm going to talk about lending practice. So before I do that, I think it's important for me to talk about the types of loans that banks make in a general situations. The first type that I want to discuss here is residential loans. So a lot of banks usually make 30-year, 15-year mortgage loans, and these loans are secured by the houses that customers are buying. And these loans are amortized over the period of the loan. So the balance on the company's book is going to go down in a kind of linear manner over time. The second type of loan is consumer credit loans, and these are riskier than residential loans in a sense that they are not secured and the interest rates are therefore higher. So average credit card rate is above 15%. The next type is auto vehicle lending, and this is similar to residential loans in a sense that it's going to amortize over the period of the loan, and also it's backed by collateral, which is the vehicle that customer is trying to buy. The next type is business and commercial loans. So business owners can borrow money from the banks to purchase inventory, manage their working capital, to expand their businesses. So there are many different reasons why business owners are borrowing money from the banks. And the rates are higher than residential loans and often do not have a standard amortization schedule. The last type that I want to mention here is construction loans. So this is one of the riskiest types. There's no physical property to be secure against, and it's just the collateral is just a piece of land. And the cash flow doesn't exist until the construction is done, and usually takes years until you see the construction is complete. So this is one of the riskiest types. So these are the different types of loans that banks usually make to their customers. Since now we understand the basic types of loans, why don't we talk about how we can evaluate which bank is good and which bank is bad? So there are 4 things you can take a look. The first one is, as we discussed, you can look at the types of loans that the bank is making to their customers and see if it makes sense. The next thing is you can also take a look at the lending mix. It's all about balancing between profit versus risk, and you want to see certain lending mix and compare that against competitors. So if the bank has a lot of construction loans and a significant portion of loan assets are composed of construction loans, then you want to be mindful about that, because the bank can make some high profits, but it can have very high risk associated with the loan portfolio. The next item also you can take a look is duration and how the management sees the duration. In a period of increasing rates, that's what's happening right now. It doesn't make sense for the banks to make a lot of long duration loans in their portfolio because the interest rate is going to rise. So it makes sense for the banks to make more loans that is more short-term duration. The last item that I want to discuss here is you can also take a look at historical write-off trends and see if it's rising or declining. So I'm going to get into more details in the next episode about non-performing loans and non-performing assets when we discuss balance sheet items and income statement items. But you want to see how these loans have performed in the past, and I think that's going to show you how prudent the risk management is within the company. Speaking of risk management, I want to also talk about the metric that you can take a look in order to understand how much capital the bank set aside for its loss absorption capacity. What I mean by that is, if you look at a balance sheet, you have asset and liability equity, right? So you can think of equity as capital put by common shareholders. So this is the capital that the bank can use to absorb losses during normal time or recession. So you want to have certain level in order to make sure that the bank can cover certain losses. So the quick metric that you can refer to is called Common Equity Tier 1 ratio. So this is the ratio that the banks have to publish on a quarterly basis. And if you take this ratio, you'll see the capital level of the bank. And also banks publish Tier 1 capital ratio and total capital ratio. The difference between these 3 different ratios is that the common Tier 1 capital represents the highest capital that the bank has, and Tier 1 is less in terms of quality, and total capital the same thing, less in terms of quality. So you want to have the bank have certain level of common Tier 1 capital maintained throughout different business cycles. Then the bank will not go bankrupt, and you'll have your money invested, and you'll get your capital appreciation at some point in the future if business does well. But if bank is starting to conserve a lot of capital more than necessary, then the bank profit is going to suffer. So this one is again a balance between profit and risk management. The regulators mandate the banks to have at least 4.5% common equity Tier 1 ratio. And what you want as an investor is you want the banks to have at least 7%. So it's above minimum requirement. So above 7%, people would say that the banks are well capitalized and can go through severe economic downturn. If you look at the ratio in the numerator, you put capital number, and in the denominator, you put something called risk-weighted asset. I'm not going to go into the details in terms of how you can calculate risk-weighted asset. It's quite complicated subject. But at a higher level, conceptually, the banks are trying to recalculate their asset value based on risk of assets. So for example, if the banks hold treasury bills, the risk is literally zero. So risk-weighted asset number for treasury is basically zero. But if you have very high risk loans, like construction loans that we mentioned, the banks have to set aside more risk asset number in order to put it in the denominator. So once you calculate this risk-weighted asset and common equity tier 1 number, you can calculate this simple ratio, and you can take a look, and it's a single number. And if you can look at tier 1 capital ratio and total capital ratio, so these are the three numbers. But from my perspective, common equity tier 1 ratio is the most important, because that's dealing with the best quality capital the bank has. But this simple ratio is powerful enough for you to understand how much capital the bank set aside, and will be used to assess the probability of this bank going bankrupt sometime in the future. Okay, that's it for today's episode. In this episode, we discussed three topics. First, we talked about deposits that customers give to the banks and why this deposit structure is important in order to analyze a bank. Second, we looked at the lending side of the business and see what are the important factors that you need to consider when it comes to analyzing a bank. Finally, we talked about capital. So why common equity tier 1 ratio is important for you to consider when you're trying to assess the risk of the bank. I hope you enjoyed this episode. And before I end, if you haven't already done so, please subscribe to my channel, and 5-star review always goes a long way. And if you want to leave any your comments or feedback, please do so at valueinvesting.blueberry.net. Thank you very much, and see you next time.